Hey guys, this is Mr. ROCC coming at you live from Palm Beach in Florida. It is Tuesday. It is May the 24th. We are going to take a look at a five in fact, small cap energy stocks. And I've done a little bit of homework here for you. And then what you can do is you can kind of stay with me for a few minutes and we review these five companies. And two of them, I think, could potentially be interesting, albeit for different reasons. But as usual, you can let me know in the comments what you think. All of them are publicly traded. One of them is an exception to the rule. It's OTC, which means over the counter. Four of them are US exploration and product. And one of them, Sandridge Energy, is US integrated. So the five companies we are going to look at is Sandridge, which I have not covered before. Ranger, which I did cover once before in a previous video. Laredo, Petroleum Holdings, Abraxas, which I had not covered before either, and Ring Energy, which I had never even heard of before. But anyway, we're going to look at these five. So at the end of the day, they're all energy companies, and let's see where they land, and you can kind of give me an idea what you think in the comments section. There are a couple of exceptions here as well. If you look at the previous close, a few of them are trading at a reasonably high price, so 20 to 36 to 68, and two of them are penny stocks. Penny stocks, as a sort of rule of thumb, means a stock that's trading below $5. Many penny stocks are on the OTC market, over the counter, or pink sheets in the United States. But anyway, if the stock price is below $5, it's a penny stock. So for the purposes of that explanation, both Abraxas, Petro, and Ring Energy are both penny stocks. So let's take a quick look here for the technical guys. I'm just going to fly over some of these. I'm not going to spend too much time on them. The 20-day raw stochastic, as a general rule, and this is very, very general, the sort of consensus is if the 20-day raw stochastic is above 80%, then the issuer's stock is overbought. So based on that description, Sandridge Energy, arguably, is slightly overbought. Ranger Oil is very close to being overbought at almost 80%, and the others look to be more like a buy. So if you're going by the stochastic as maybe a starting point, because it shouldn't be a singular benchmark for you, then you could say Sandridge is less interesting than the rest. But that's highly debatable because you need to look at some other benchmarks as well in addition. From a weighted alpha point of view, the outlier here is once again Sandridge with a weighted alpha of 256. The others are either negative or a low number. This kind of measures them against their peers, not against the entire market as a whole. The analysts, I don't know how many analysts are covering this. So in the case of Ring Energy here on the far right, 100% buy might be one analyst. So I'm not too sure about that one. I haven't gone that deep into these five stocks. But we'll take a closer look at two of them, as I said, in just a minute. Last month's opinion on Sandridge was 80% buy, 56, 56, 40, and then 100% being the outlier there on Ring. So overall, the ratings buy, but 40% buy obviously means that there are less people, analysts specifically, analysts, saying buy this particular stock for whatever reason. I have not gone into that. I didn't go to my tip ranks repository to see which analysts are saying what. So I don't have an opinion to share with you on that right now as we speak. So let's take a look at the next one. We have a performance year, and for the purposes of this video, I'm not going to look at 5 days in 1 month. I'm assuming that the majority of people on my video are not day traders, so we'll skip this for now. But if we look at the 3 month, I have a performance here from Sandridge of 74%, which is pretty good. And the other one that has performed pretty well was Abraxas. And then we have a bit of a mixed bag for the other three, but certainly the two top performers at around 70% over a 3 month period was Sandridge and Abraxas. The same is true if you look at the 6 month period, which is more to my liking as a rule. I've shared with you before that when I open a position, I typically hold that position for about 3 to 5 years. I have exited positions prior to 3 to 5 years. For instance, if the fundamentals have changed dramatically, I might exit a position, either taking a profit or a loss. But as a general rule, I'm staying within my positions that I've acquired for approximately 3 to 5 years. Good performance here over a period of time, say 6 months or so. We'll look at 1 year in just a minute. The PE ratio is something I look at frequently. Abraxas doesn't have a PE ratio, which probably means it had negative earnings. But if you look at a different period, so this is trading 12 months, I'm going to show you Abraxas in a minute because I'm going to do a deep dive on Abraxas and Sandridge. Sorry, I shouldn't have said deep dive. I'm just going to do a high-level flyover, but we are going to take a little bit of a more in-depth view on Sandridge Energy and Abraxas Petro Corporation, respectively. The PE ratio on Sandridge is very attractive right now at 6.47, so 6.5. And in fact, to be fair, they all have a very attractive PE ratio. Anything under 15, as I've said many, many times before, is interesting to me for a variety of different reasons. There are a couple of interesting sort of observations one we can make from looking at this particular slide that I'm sharing with you here. The market cap, and this is in thousands, so 1.1, almost 1.2 billion for Laredo Petroleum, for a company that generates approximately 1.4 billion in sales. So there's a little bit of a disconnect there in terms of how the market values Laredo Petroleum Holdings compared to the company's performance. But I'm going to skip Laredo Petroleum. If you have a position in the three that I'm going to skip, so Ranger Oil, ROCC, or Laredo Petroleum, LPI, or Ring Energy, please let us know in the comments and tell us what the compelling reason was for you perhaps to open that position or why you hold it. If we look at the chart, yeah, I'm going a little bit longer. So previously I looked at 3 months and 6 months. If you look at this over a year, I mean, if you were long on Sandridge, you're a happy camper. It's up 300%. And then you have this little grouping here in the middle. And these two guys, so ROCC, and that's the blue line, and then REI, very, very good performance, nearly 100%. And then the rest drop off, and Abraxas has been the worst performer. We're coming in at negative 31, which is quite concerning when you take into consideration that energy stocks as a general rule have just been flying off the charts. So let's take a look at Abraxas and see what's going on here. You can buy it, as I said, over the counter, OTC. Cheap, arguably. It's certainly cheap when it's priced at $1.89. But is it cheap? Well, that's what we got to do when we dive a little deeper into the stock. In terms of its 52-week range, we can see it's sort of left of center here. It would have been a nice stock to buy at about 50 cents because it's now trading at $2, so it would have given you a 4-bagger. But its 52-week high is $5. So if you can buy it for $2 and it goes back to $5, say, you got a 2.5-bagger or a 2-bagger, that ain't too bad. It's a small company. It's got a market cap of only $15–16 million. And the PE ratio, which is different from the previous slide that I shared with you, is almost 1. So super cheap. But remember, sometimes based on PE ratio alone, companies are cheap for all the wrong reasons. So let's take a look at 2 more slides on Abraxas and just kind of do a quick flyover here in terms of, firstly, its financial strength analysis. This is a pretty good picture. I always look at the company's debt. Abraxas uses little or no debt in its capital structure and may have less financial risk than the industry aggregate. Why is that important? Simply because companies that have no debt or very little debt hardly ever go out of business. That's why that's important, and that's why that's a good thing. The total debt to capital ratio for Abraxas is only 4% or slightly below 4%. The industry median is almost 40%, 10 times greater. And then down here at the bottom, if you look at the interest coverage, simply obviously because of the fact that Abraxas has hardly any debt, the industry median is quite low right now at almost 10, and Abraxas has an interest coverage for the most recent quarter of almost 70. Big difference. How about profitability? Abraxas is one of the most profitable companies in the oil, gas, and consumables fuels industry. Its operating margin is amongst the strongest of any peer, while the gross and net margin are above the industry medians. So now you already have 3 different benchmarks which Mr. ROCC would apply to potential stock picking. Firstly, it's got a very low PE. Secondly, it has very low or almost zero debt. And now we're looking at profitability, and we can see on a gross profit margin basis for the trailing 12 months, the industry median was 35, Abraxas at 70 is twice as profitable as the industry mean. And then if you look at the net profit at the bottom here, the industry median is 6 for a trailing 12-month period, and Abraxas was 26. So 4 times plus better than the industry median. So not too bad, right? So I'm not making a suggestion here because this would be a bit of a gamble. But, you know, this is one of those stocks where you can buy maybe a little bit of Abraxas at, you know, $2 and see where it goes. And, you know, if you just take a, you know, small little position, dip your toes into the water here, if it goes down, you don't lose too much. And on the other hand, if it goes to, you know, $4 or $6 from your $2 entry point, you probably kick yourself, but who knows, right? Because we cannot predict. And anyway, don't forget that we are facing a looming recession unless there's some radical change in terms of Fed and administrative policies in the United States. Now we're going to take a look using the same metrics on at Sandridge. This one you can buy on the New York Stock Exchange. It's a publicly traded stock with reasonably high volumes. 566,000 is below average for the day, $20 per share or thereabouts. And then if we look at the 52-week range here, you would be buying into Sandridge at its close to its 52-week high. So maybe for some people, this doesn't matter at all. For me personally, I would wait until there's a little bit of a pullback before I open a position in Sandridge, but it certainly is an interesting company for a variety of different reasons. One of those is a PE ratio of only 6. It's very, very attractive. The average right now, PE ratio, or the median, I should say, not the average, on the S&P 500 is close to 15. So 6 indicates a forward ratio that is really cheap in terms of where the stock is currently priced. It seems as if the institutional investors are aware of this because we can see Sandridge, unlike Abraxas, has institutional holdings of 64%. That is quite high, especially for a company with a market cap of only $780 million. But you know what? If you picked this one early, you would have made a really, really decent profit. As I showed you on the previous slide, just over the past year, it's up 300%. What about Sandridge's debt? Well, it also has little or no debt and therefore very little financial risk. How little? Well, 0. The industry median, as I said, with Abraxas is close to 40. Sandridge has almost 0 debt. Down here at the bottom, you can see its interest coverage for the most recent quarter. The industry is at around 10. Sandridge is about 30, which is 3 times greater than the industry median. Is it profitable? That's a good question to ask, right? It's one of the more profitable companies in the oil, gas, and consumable fuels industry with a net margin of 60.4%. Its operating margin and net margin are among the strongest of any peer, while its gross margin is above the industry median. How profitable? Well, the gross margin for the trailing 12-month, the industry is 35. Sandridge, even better than Abraxas, is at 73. Abraxas was at 70. And the net profit, is it making a profit? You betcha. The industry median is at 6, and Sandridge is at 60% net profit margin for the trailing 12 months. So guys, this is 5 stocks. 2 of them are micro, penny stocks trading for less than $5. For different reasons, Abraxas is interesting to me just because it's a really small cap company and it seems to be trading quite low. And the current price of around $2 is way off its high, which was over $5. So it's interesting to me from that point of view, plus the reasons that I shared with you. And then Sandridge is interesting to me as well as a company that I might potentially look at and open a small long position, see where it goes, maybe build it over time. Who knows? You can't predict. And right now, in terms of the macroeconomic climate that we're in, it's very difficult to predict almost anything. I hope there is the situation in the Ukraine is resolved soon. We don't need that as a distraction. Other things that they try to scare you with, including new viruses, may or may not be material. It's a tough time to make investments right now, and it's tough to pick. So I'm hoping that the information and the news that I'm sharing with you on some of these stocks are valuable to you. But either way, you can let me know in the comments what you think. And I look forward to those comments because usually you share good stuff with me. So thanks for watching. I'll see you soon. Bye-bye.